Welcome to Money and Markets Series 2, Lesson 2. This episode is called Defaulting Before Bankruptcy. In Lesson 1, you mapped the risk landscape. Systematic versus non-systematic. Economic, equity, interest rate, model. Now we zoom into the one type that matters most for the borrower-lender relationship. What happens when a borrower stops paying? Not all at once. Not with a dramatic explosion. Default usually starts quietly. A missed payment, a late fee, a phone call from the bank. And then, if nothing changes, a legal process that can end in bankruptcy. This lesson walks through that escalation, step by step. From overdue, to grace period, to default, to bankruptcy. You will also learn about covenants, cross-default, and the Italian origin of the word bankruptcy itself. By the end, you will understand the timeline that every lender fears and every borrower should know before signing a loan. It starts with an overdue payment. Every loan has a due date, a specific day when the borrower must make a payment. Principal, interest, or both. If that day passes and the payment has not arrived, the payment is overdue. Now, overdue does not always mean trouble. Sometimes it is innocent. A holiday delayed the bank transfer. A processing error held up the wire. The money is coming, it is just late. But sometimes, overdue means the borrower cannot pay, or will not pay. And that is a different situation entirely. The lender does not know which case it is on day one. All they see is a missing payment. That ambiguity between innocent delay and real trouble is where the timeline begins. Next comes the grace period. Most loan contracts include a window of extra time after the due date. This is the grace period. Typically 15 to 30 days, depending on the contract and the jurisdiction. During the grace period, the borrower can still make the payment without triggering the worst consequences. Think of it as a buffer. But the clock is ticking. If the grace period passes and the payment still has not arrived, the lender starts to act. Late fees accumulate. The interest rate on the outstanding balance may increase. The lender reports the delinquency to credit bureaus, which means the borrower's credit score takes a hit. And if the borrower continues to miss payments, the situation escalates further. What started as a single overdue payment becomes a pattern, and patterns trigger more serious contractual consequences. Now, covenants. A covenant is a condition written into the loan agreement that restricts what the borrower can do. Think of it as a set of rules the borrower agrees to follow in exchange for receiving the money. Some covenants are financial. The borrower must maintain a minimum cash balance, or keep their debt below a certain ratio, or meet specific revenue targets. Some covenants are operational. The borrower must not sell major assets without permission, or take on additional debt beyond a limit, or change the nature of the business. Covenants exist because the lender wants early warning. If the borrower starts behaving in ways that increase the risk of default, the lender wants to know and wants the contractual right to act. If a borrower violates a covenant, the lender can demand early repayment, renegotiate the terms, or in some cases, declare the loan in default, even if the borrower has not missed a payment yet. Cross-default is where things get dangerous. Many companies have multiple loans from multiple lenders. A credit line from one bank. A bond issue held by investors. A lease agreement with a landlord. Cross-default means that if the borrower defaults on one obligation, it can trigger default on all of them simultaneously. Here is why that matters. Imagine a company misses one payment on a small loan. Under cross-default, the other lenders can immediately demand full repayment of their loans too. The company now faces demands from every direction at once. If the company has the cash to settle, it survives. If it does not, and most companies in distress do not, the cascade of demands pushes it into bankruptcy. Cross-default is the reason a single missed payment can destroy a company. Not because the missed payment itself was large, but because the contractual chain amplifies it into a liquidity crisis. Default itself is the formal term. Default means the borrower has failed to meet the financial obligations as agreed. Not just late, not just overdue. Failed to pay, after the grace period, after the warnings, after the covenant triggers. For an individual, default might mean a mortgage in arrears for 90 days or more. The bank starts foreclosure proceedings. The house is at risk. For a company, default might mean missed bond coupon payments, violated covenants, and lenders invoking cross-default clauses. The company's ability to borrow evaporates overnight. Default is not the end of the story, but it is the point where the relationship between borrower and lender breaks down and legal processes take over. The lender now has limited options. Negotiate a restructuring, seize collateral, or pursue the borrower through the courts. None of these are fast. None of these make the lender whole. Default always destroys value somewhere in the chain. And then, bankruptcy. The word itself tells you its history. Banca rotta, Italian for broken bench. In medieval Italy, money dealers conducted business at benches in the marketplace. If a dealer could not meet his obligations, his bench was physically broken in the public square. A visible, humiliating signal that this person could no longer be trusted to trade. Modern bankruptcy is more structured, but the core idea is the same. The borrower cannot pay, and a legal process determines what happens next. In most systems, there are two main paths. The first is liquidation. The borrower's assets are sold, and the proceeds are distributed to creditors in a specific order of priority. Secured lenders, those with collateral, get paid first. Unsecured lenders get whatever is left, which is often very little. The second is reorganization. The borrower proposes a plan to restructure debts, reduce payments, and continue operating. This is common for companies. It gives the business a chance to survive while creditors accept modified terms. What happens after bankruptcy? The borrower does not disappear. In modern systems, bankruptcy law actually protects the borrower to some extent. A small business owner who goes bankrupt may still be allowed to keep operating. The required payments to lenders may be reduced. Personal assets may be partially shielded, depending on the jurisdiction. This is very different from history. Debtors used to face prison. In some eras, they faced worse. Modern bankruptcy law exists because societies decided that destroying a person for failing to pay a debt is worse than giving them a second chance. But second chances come with consequences. A bankruptcy stays on your credit record for years. Future borrowing becomes more expensive. Lenders charge higher rates to anyone with a history of default because the data says they are more likely to default again. This is the credit risk loop. Default leads to worse terms. Worse terms increase the pressure. And the cycle continues unless the borrower rebuilds trust over time. Why does this matter for you as a saver or investor? Because when you deposit money in a bank, or buy a bond, or invest in a company, you're a lender. You have given someone your money in exchange for a promise to pay it back. Default risk is the risk that the promise breaks. In Series 1, you learned that interest rates reflect risk. Longer maturity, higher rate. More uncertainty, higher rate. Now you see the specific mechanism. The rate you earn on a corporate bond versus a government bond reflects the market's estimate of the probability that the corporate borrower will default. That difference is the credit spread. The rate you pay on a mortgage reflects the bank's assessment of your probability of default. Your credit score, your income, your employment history all feed into that assessment. Every interest rate you have ever seen has a default component baked inside it. This lesson showed you what happens when that component comes to life. 3 takeaways to carry forward. 1. Default is an escalation, not an event. It starts with an overdue payment, moves through a grace period, triggers covenant violations, and can cascade via cross-default into full bankruptcy. The timeline matters. 2. Covenants are the lender's early warning system. They restrict the borrower's behavior to reduce the chance of default. Violating a covenant can trigger consequences even before a payment is missed. 3. Bankruptcy has 2 paths, liquidation and reorganization. Neither makes the lender whole. Modern law protects the borrower to some extent, but the credit consequences last for years. Next lesson, we look at credit risk from the lender's side. What is a bank run? What does deposit insurance actually protect? And what happens to your money when the bank itself is in trouble? I will see you in Lesson 3.